Hello, friends. Good morning to all of you, and welcome to learning sessions. And we were discussing in the last session about the treasury risk management, and we covered almost all the part. But we were left with some like the some topic related to the duration. So do confirm the audio video quality at the earliest so that we can proceed with today's session. Just do confirm the audio video quality at the earliest. And further, if you have not subscribed to the channel, do subscribe to the channel at the earliest so that you get notified whenever we upload the new video. The audio video quality is working all fine. So let's start the session here. So I told you about the properties of duration, that duration is a measure which tells us about the impact of the interest rate risk, and also duration is measured in years. It's basically represented in years, and duration is less than the term to maturity. But in only the case of the zero coupon bond, the duration is equal to the maturity, right? And what about the perpetual bonds, like which are having no maturity? In that particular case, it is equal to 1 plus r divided by r, where r is the current yield, right? So we have already gone through these properties. We have already followed these properties. Now, after that, let's understand that duration is a measure which helps us so as to understand the impact of interest rate on the price. Now, we do look into the periodicity of the coupon rate, right? Or the coupon flows. Now, that's going to impact the duration. Now, if we are having the much more frequency, let's say we are having the more frequency of the coupon, then the duration will be lesser. I already told you. So the coupon frequency is increased as compared to if the coupon frequency is lowered and everything other than that is all same. In that scenario, the duration where the frequency of the coupon is more will be lower, right? And it is expressed in years. Longer the duration, longer is the sensitivity of the bond, and more is the risk associated with it. Clear with it so far? So longer duration means higher interest rate risk is there. And further, for the treasury management purposes, the portfolio duration is more important than the duration of the individual bond when we are talking about the portfolio, right? For the treasury management purposes when we are talking about that. So what we can be interpreting from the same, that longer the duration, greater price volatility is there, and shorter the duration, lower price volatility is there, right? So duration is a very practical tool, so which can be used for the interest rate risk measurement, for the portfolio immunization, for the asset liability management, and also for the bond comparison. It is very much important. The another concept related to the duration is a modified duration. Now, modified duration gives us a much more direct measure of the bond price sensitivity, and it is equal to duration divided by 1 plus r, where r is equal to YTM divided by the frequency of the coupon that you are getting, where r is equal to the YTM, that is yield to maturity, required rate of return, right, divided by the frequency of the coupon, right, that will be equal to it. Clear with it so far? So let's say if we are having the YTM of 6%, if we are having the YTM of 6%, and we calculated the duration to be 4.33, so it will be equal to 4.33 divided by 1 plus 6% of the YTM converted into the decimal part, that is 0.06. And for the, let's say if we are getting the annual coupon, then it will be divided by 1. So frequency is 1 here, right? So we can be calculating the Macaulay modified durations from here. From the Macaulay duration, we'll be able to calculate the modified duration here. Now, what is the significance of the modified duration? Now, it estimates the percentage change in the bond price for a unit change in the yield. So let's say if the percentage change in the particular bond price is to be calculated and we are having the modified duration. Let's say we calculated the modified duration. We calculated the modified duration to be 4.33 years, right? Now, what does this indicate? It indicates that if there is unit change in the yield. Let's say the previous yield was 6% and now it is increased to 7%. There is unit change, like it is changed by 1% now, right? It's changed by 1%. Now there will be 4.33% change in the bond price. 4.33% change in the bond price. Now, how you will be knowing that the prices are going up or down? Because I have already explained this idea to you. Why? The bond prices are inversely proportional to the interest rate. The bond prices are inversely proportional to the interest rate. Now, what does that mean? That if the interest rate increases, the bond prices will become low, right? They'll come low. So in this case also, the percentage that interest rate is increases, the interest rate is increasing, so the bond prices will be lowered. So when we're talking about the change in the bond price, there will be a negative sign. There will be negative sign. Why? Because now the bond prices will decrease. Clear with it so far? Do confirm. So if we are having the previous bond price of, let's say, 995 rupees, now it will be decreased by 4.33%. So from using the modified duration, right, we can easily be calculating the bond prices also, like increase in bond price or decrease in bond price if there is unit change in the YTM, if there is unit change in the YTM or the required rate of return. Clear with it? Do confirm, because you may be asked a 5 point question in the exam, like so as to calculate the duration, so as to calculate the present value of the bond and so on. So we'll be covering a particular point related to it, no worries, right? So next topic, it's about the YTM of the bond. So the next topic that we're going to cover over here, it's related to the YTM of the bond, right? Now, what is YTM? The YTM is yield to maturity. It is yield to maturity. So simply we can say the YTM is the discount rate. YTM is what? YTM is the discount rate at which the present value of the cash flows or the present value of the bond that becomes equal to the current market price, right? So simple definition, mathematically it is having a very simple definition. So YTM is the discount rate, right, at which the present value of the bond that will become equal to the current market price. And it is basically the rate of return which is earned by the investor who buys the bond at the current market price and also holds it till maturity. It is also that particular rate of return that you're going to get, right? So we are going to assume that there is a one assumption in the case of the YTM. There is assumption. What is the assumption? That whatsoever the coupon payment that you're going to receive. So what actually happens, that in case of the bond, I've already explained this timeline to you in the previous session, that let's say we are having a 3-year bond, 0, 1, 2, 3, right? So let's say it is a rupees 1000 bond, and let's say you're getting a coupon of 10% here, right? So 10% of 1000 rupees means rupees 100. So you're getting rupees 100 each and every year. So we are just assuming that this 100 rupees is getting invested at the same rate, right? We are investing it at the same rate, the rate which basically is available over there, or what we are getting, the coupon we are getting, it is basically reinvested at the same particular rate, right? That's a assumption in case of the YTM. So it's like that when you are going to what interest you are going to earn or what rate you are going to earn when you buy the bond at the current market price. Now, the one, it is related to the face value at which the company will be offering you the bond, and one it will be related to the market price of the bond in the secondary market. Like let's say it's available for at a discount of rupees 50. It's available for rupees 950 in the secondary market. So you got a bond at rupees 950 from the secondary market and you're going to hold it till maturity. Now, what rate you will be earning will be the YTM. What rate will be earning will be the YTM. So it's a discount rate where if we discount all the present value of the bond, then it will become equal to the current market price of the bond. Simple as that, right? And what is going to tell you? What are the features of YTM? Basically, it includes a coupon income, it includes a capital gain or loss on maturity, it includes a time value of money, and it assumes that bond is held till maturity. There are some assumptions related to it, right? So it assumes a few things. Let's have a look at it. It's quite important from the question point of view also. So first thing it assumes is like the bond is held till maturity, right? First thing. And second thing, it's related to reinvestment of the coupon at the same YTM. Reinvestment of the coupon. I already explained this to you. And further, the third assumption is like there will be no default in the coupon payment. You'll be getting the coupon on time, right? And further, what does YTM does? The YTM does not reveal. The item tells you that what return that you are going to get, right? If you're going to hold the bond till maturity, but it does not measure the price volatility. Price volatility is basically not, told by the YTM, right? So it could be the case that the YTM of the two bonds may be the same. So just look at this particular point. It could be the scenario that you're having the YTM of two bonds equal, right? But the price risk associated with them may be different, right? On maturity or on frequency of coupon payment, that may be different. Clear with it? So YTM is basically the rate of return from holding of the bond till maturity. That's basically the YTM means. And when we're talking about the duration, it means the weighted average time of receiving bond cash flows. If we look at the units, the YTM is basically represented in percentage. The YTM is represented in percentage where the duration is represented in years. And in case of YTM, we are focusing upon what? We are focusing upon return. But in case of the duration, we are focusing upon the interest rate risk, right? So that's about it. So I hope that you must have understood all the concepts related to it. Now, let's have a look at how we are to solve the question for the duration. If there is some case study asked to you related to duration, how we are going to solve it. Let's just have a look over it. So let's assume the data that will be given to you in case of the question related to duration. Let's say it is a 3-year bond, right? And rupees 1000 is the face value of the bond. And let's assume the coupon is 8%. And let's assume that the YTM is given to be 6%. We are assuming it to be 6%. And they will be telling us in the question so as to calculate the duration. Now, how we will be doing the same? How we can be calculating the duration here? So we have to make a table there. One, it is related to, there will be 5 columns: A, B, C, D, and E. The first column is related to T, that is time. When you're getting the coupon, right? So we are getting the coupon on annual basis because it is not told us anywhere that will be getting the coupon on half yearly basis or quarterly basis. So we are getting the coupon on yearly basis. So T will be equal to 1, 2, 3. On the other hand, if we were getting the coupon on half yearly basis, then it would have been 0.5, 1, etc. Right? Getting it? So now here it will be 1, 2, and 3. We are getting the coupon 3 times. The second one, it will be related to the cash flow. What cash flow will be there? Like the coupon amount, right? So we are getting the coupon at 8%. So 8% of 1000 rupees, that is 80 rupees. So we are getting 80 rupees for the first year, second year. And in the last year, we'll be getting the maturity value of rupees 1000 also. So the total amount that we'll be getting in the third year will be 1080. 1000 plus 80 rupees. So 1080 is the amount that we'll be getting in the third year, right? And further, after that, it's about the option C. That's a table. We are to calculate the present value factor. The third point, it's related to the present value factor here. Now, how we can be calculating the present value factor? If you remember, I told you about the discounting factor. The formula is quite simple. That is 1 divided by 1 plus r raised to power n. Now here r is the YTM and YTM is given to be 6%. That is 0.06. So we have to calculate for the first year like 1.06, 1 divided by 1.06 raised to power 1. For second year, it will be 1 divided by 1.06 raised to power 2. So we can simply be calculating it using the simple calculator. So it will be 1 divided by 1.06. For the first year, it is 0.943. And for the second year, it is 0.889. For the third year, it is 0.839, right? So this is a present value factor. And further, the fourth would be equal to the present value. Now, how we can be calculating the present value? B multiplied by C. We have to multiply the cash flow with the present value factor, and that will be the present value. So that is equal to 80 multiplied by 0.943. That is equal to 75.44. The second one, it will be equal to 0.889 into 80. That is 71.12. And the third one, 1080 multiplied by 0.839. That is 906.12. Now, these are the present value that we calculated. And if we get the sum total of this column D, that will be equal to summation of PV. And that is equal to 906.12 plus 71.12 plus 75.44. That is equal to 1052.68. That is the present value that you're getting. Now, in the column E, we have to multiply this D column with the A column. That is PV dot T, right? So we are getting in the fifth column, we are getting PV dot T. Getting it? So it's quite simple. Now we have to multiply 75.44 with 1. That is 75.44, right? Second one, 71.12 multiplied by 2. That is 142.24. And third, 906.12 multiplied by 3, that is 2718 so plus 142.24 plus 75.44, that is 2936.04. This is summation of PV dot T, sum of all these terms. Okay, getting it? So that is actually equal to it. Now, what was the formula related to duration? Duration was equal to summation of PV dot T divided by summation of PV, if you memorize. So it is equal to 2936.04 divided by 1052.68. So divided by 1052.68, that is equal to 2.789, and duration is in years. So this is a duration that you're getting. So this is the duration, that how we can be calculating it. Okay, and what will be the modified duration here? So if we are to calculate the modified duration, it will be equal to duration divided by 1 plus R. Now here we are getting the coupon on yearly basis. So 1 plus R means 1 plus YTM divided by 1, right? So duration is equal to what? It is equal to 2.789 years. And further divided by YTM is 6%. So 1 plus 1.06 here. So 2.789 divided by 1.06, that is equal to 2.63. So the modified duration here we calculated is 2.63 years, right? So for unit change in the YTM, the percentage price change will be 2.63%. the percentage change in the price will be 2.63%. Clear with it? Do confirm that if you have understood this particular part. So how we just calculate it? We are to basically calculate these five columns. First column is T, second is cash flow, third is present value factor or discounting factor. The third one is the fourth one is the present value, multiplying the B with the C. And the fifth one is PV dot T that we need to calculate, that is uh, A into D, right? And that's how we can be calculating the present value total and for the PVT total, and just dividing PVT by the PV, and that will be getting the duration, right? So this is quite simple that how we can be calculating the duration. Now that was all about the chapter number 4, and now we are heading toward the chapter number 5, that's related to the derivative products. Very important chapter from the exam point of view, also a very important chapter, that's about the derivative products, right? And we've already covered a few out of it. We have already covered a few out of it. Like we have already covered the points related to the FRA, related to the forwards, OTC contracts, ETC, etc. So we are not going to repeat them all again. We are not going to repeat them all again, and we'll be leaving it in between only, right? So I'm just giving you the first idea related to it. So it's about the chapter number 5 from the module C of the treasury management, and it's the derivative products. So derivatives are what? Derivatives are the financial instruments, those who are not having the value of their own, and their value is basically taken from the underlying asset. Now these underlying asset could be what? These underlying asset could be the foreign exchange rates, interest rates, this could be the commodities, this could be the market indices, right? That's the point related to it. And in case of the treasury, we do use a derivative for the risk management purposes. We use the particular for the derivatives for the risk management purposes. Like we want to hedge our interest rate risk or foreign exchange risk or asset liability management mismatches, right? We want to basically hedge them. We want to safeguard them. We also use the derivative for the customer facilitation. Like we want to provide the hedging solution to the corporates, to the individuals, right? We want to basically manage the export import exposure. For that particular purpose also it is used, like for the customer facilitation, for the customer, so as to provide the services to the customers. We do use it. And also we use it for the speculation purposes or the trading purposes, like so as to take the position in and so as to earn the profit from the market movements. We use it for that particular purpose also. And we are having the two type of products, like we are having the over the counter products or we are having the exchange traded products. Over the counter means a bilateral contract between the two parties. Now if the two parties are dealing with each other, definitely it's not standardized, it can be tailored, it can be customized, right? And it is offered by the banks and the financial institutions, and the price quoted by the bank, price is quoted by the bank. It's not like screen based pricing, right? And further, the security requirement also depends upon the client profile. And definitely when the two parties are dealing with each other, definitely the counterparty risk will be there in case of the OTC contracts. And mostly the delivery which is there in case of the OTC contracts or over the counter contracts is the physical delivery. It's the physical delivery which is there, right? And this is primarily used for the hedging purposes. Primarily the over the counter contracts are used for the hedging purposes. Clear with it? Do confirm at the earliest. The second one, it's about the exchange traded derivatives. The exchange traded, now which are like traded on the recognized exchanges. These are traded on the recognized exchanges, and further these are having the standard contracts. So there is standard contract size, standard maturity is there, and transparent screen based pricing or electronic trading system is there. And the settlement is done on daily basis. In case of the exchange traded derivatives, like the settlement is done on MTM basis, mark to market basis. So whatsoever the value at the end of the day, right? The value of your portfolio will be, fixed according to that. And in this scenario, the margin is collected by the exchange and there is no counterparty risk. Why? Because these are traded on the recognized exchanges. So no counterparty risk is there because the exchange is acting as the central counterparty. You are not dealing with the counterparty directly. You are dealing it through the central counterparty. So there is no counterparty risk. And mostly the settlement which is there in case of the exchange traded the derivatives, it's a cash settlement. In most of the cases, the settlement which is there is a cash settlement, right? And this is widely used for the trading purposes, for the speculation purposes. Further, let's have a look at the difference between the same. I have told you all, but let's have a look at it, the difference. First of all, it's about that the products offered by the banks and the financial institutions and further traded on the recognized stock exchange. That's about the definition. The second one, it's about the nature, we can say. So it's basically the nature is customized. In case of OTC derivatives, it's customized, whereas in the case of the exchange rate derivatives, it's standardized maturity, standardized terms, etc., right? And further, in case of the particular OTC, the price is quoted by the bank. Like they will be adding a margin toward it and they'll be quoting the price. But in case of the exchange traded derivative, there is a transparent pricing, a screen-based pricing or order matching will be done, right? And further, in case of the OTC, in case of the OTC, the margin is basically maintained. Margin is maintained, but that will be maintained at the bank's discretion based upon the client status. So if you have to take the security or not, that depends upon the bank's judgment about the client's status, right? But in case of the exchange traded derivative, the daily margin is collected and further the calculation will be done and it will be the MTM value. It will be the MTM value, daily MTM margin is to be maintained, right? And if we talk about the counterparty risk, that's present in case of the OTC contracts, but not present in case of the exchange traded contracts, derivatives, because the central counterparty is the exchange and settlement is mostly physical delivery. I told you already. It's mostly the physical delivery. And in case of the exchange traded, it's mostly the cash delivery. Mostly the cash delivery, right? And the OTC contracts are majorly used for the hedging purposes, whereas the uh, exchange traded contracts are majorly used for the trading and speculation purposes, right? So derivatives are specifically having three types. We are having the forward contracts, options, and the swaps. The first one we are going to cover, it's about the forward contract. We have covered the complete points related to the forward contract. So let me just give an idea related to it and we'll be moving ahead. Leaving this topic, we have already covered this topic completely in the module A, right? So what about the forward contract? So forward contract is the OTC agreement, over the counter. So it's a over the counter derivative, and it's an agreement as to buy or sell the asset at a fixed price but on a future date. Let's say the person A wants to buy 10,000 USDs 3 months from now. 3 months from now, he want to purchase 10,000 USDs, right? So the person A will be going to the bank and will be asking so as to buy, he wants to buy the USDs. Now person A will be able to buy the USDs at a price at which the bank is ready to sell. So it's a merchant rate which will be given by the bank, right? And for the forward rate, or the forward rate, is basically composition of two parts. The forward rate is equal to spot rate. It's equal to the spot rate, and for the plus minus premium or discount. This is how we do calculate the forward rate, right? And for the, it is basically used for the hedging purposes. It eliminates the exchange rate risk completely. We can be doing the rate locking for this. So let me write the features we can say. So what are the features over here? The first thing, it's used for the hedging purposes. The second one, we can lock the rate. We can do rate locking, like fix, we are going to fix the future value of the currency. And for the customization is available definitely because it's a OTC contract. So definitely the customization can be done, and it is OTC in nature, over the counter derivative it is. And what are the advantages? We can completely do like what? We can be, we can get the complete protection against the adverse exchange of the rate movements. Like definitely we can get so. So there is certainty in the cash flows because the bank will be having a like obligation now. After 3 months, let's say if I'm going to purchase the USDs, I basically entered into contract at rupees 89. Now, whatsoever the market price it is, let's say it is 92 rupees, 95 rupees, or whatsoever it is, I'll be getting the USDs at 89 rupees only, right? So definitely it's very much useful for the exporters as well as for the importers. What are the disadvantages? Now, let's say if I book the contract at 89 rupees and the price after 3 months, the USD price dropped to 88 rupees. I cannot be getting the benefit of the market price. I am to basically go for this 89 rupees, the contracted value only. I cannot be getting the benefit if the market moves favorably, right? Simple as that. So I'm to lose the opportunity. I'm to lose the opportunity. So that's basically would be counted as what? That will be counted as the opportunity loss. That will be counted as a opportunity loss. So that's a disadvantage. Okay. So after that, it's about the options. The next topic that we're going to cover about it's the options. Now, option is what? Options are the contracts which are going to provide you with the right. So you'll be having a right with you, but that won't be an obligation. We have already covered the options topic also previously, right? So I'm just giving you an idea related to it. So options derivative contracts, basically derivative contracts. So you'll be having a right, like in the problem in the case of the forward was what? That you're not going to get the benefit if the market is favorable for you. But now you can be getting the benefit. Like if it is favorable for you, do execute it. Like if it is not favorable for you, do not execute it. Right? So option is like it gives you a flexibility. It gives you a right, but that will not be an obligation. Okay. So it will be a right without obligation, we can say. It's a right, but not the obligation, the first point. And also, a premium is to be paid. Like premium is what? That is a price paid by the buyer to the option writer, to the seller of the options. We have to pay a price, a fixed price, and that won't be refunded to you. And that is to be paid upfront. Okay. And further, the third term that we should be understanding, it's about the strike price. So strike price, or we can say it's the exercise price. It's said to be the exercise price, the strike price. So it's a pre-agreed price at which the asset can be bought or sold. It's a pre-agreed price at which the option can be executed, right? At which you can be buying something or selling something. So we are having the two type of options. We are having the call option, which gives you a right to buy. It's related to right to buy. And the second one, it is a put option, which gives you a right to sell, right? So the price at which these options will be executed, that will be the strike price. And then it's related to the maturity date. We can simply say it is a expiry date when the particular option contract will expire. So the last day on which the option can be executed, it can be exercised, that's the maturity date. And further, if we are talking about the option writer, if we are talking about the option writer, the person who is going to sell you the options, and the option writer is having the unlimited risk. The option writer is having the unlimited risk. So the option writer will be having an obligation. It won't be having a choice, and they are to fulfill the contract if the buyer exercises that particular contract. So the unlimited risk is there with the option writer, and the premium is to be paid to the option writer. The option buyer will be paying a premium to the option writer. Now we are having the types of options, like we have the call option, which gives you a right to buy. The call option gives you a right to buy, and the put options gives you a right to sell, right? So in case of the call option, the buyer benefits when the market prices rises above the strike price. Like you have the current trading price of a share is rupees 100, and you basically purchased a call option for the same at rupees 1 for rupees 130. So the strike price is rupees 130 for this particular share, right? And let's say after 1 month at that on the date of execution, the market price of the share is 150. The spot price after 1 month on the date of maturity it is 150. Now, what does this indicate? You're having the call option with you, right? So this indicates that whatsoever the market price is, I'm having a right that I can be buying the share at rupees 130. That's the strike price. So definitely, if I'm getting the share at rupees 130, whereas the in the market it is available for rupees 150, that's beneficial to me. That is beneficial to me, right? So that's about the call option. Okay. And on the other hand, the put option gives you a right to sell. It gives you a right to sell of an asset, right? So buyer is going to benefit when the market prices fall below the strike price, right? So if the, let's say if the spot price is here or the spot rate is here, if it is lesser than the strike price, then it will be favorable in case of the put option. Then it will be favorable in case of the put option. So when the particular option is favorable to us, we say to be ITM. We say to be in the money if it is favorable. And if it is not favorable, we say to be OTM, out of money. If there is no profit, no loss, then we say to be ATM, at the money. And based upon the mode of the settlement, the options are divided into two types. One, it is the American type option, and the second one, it's the European option. In case of American option, it can be exercised anytime before the expiry. It can be exercised anytime before the expiry. Let's say the option is going to expire after 1 month, right? So you can be executing it anytime in between or on the date of maturity. But in case of European type option, which is used in India also, right? In that scenario, you can be executing it on the date of maturity only. On the date of maturity only. Then it's about the moneyness of options. It's about the moneyness of options. Like I just told you, if it is favorable, then we say it to be ITM. If it is not favorable, we say it to be OTM. And further, if the strike price is equal to spot price, like no profit, no loss position is there, then we say it to be ATM. So three positions are there, like no profit, no loss, ATM. When you're having profit, when it is favorable, we say to be ITM. And when it is like loss to you, then we say it to be the OTM. Clear with it? Further, we should be understanding a point related to the notional value and the settlement. Now, the options are based upon the notional principal amount. These are based upon the options are based upon the notional principal amount, right? So only the net difference is settled. Only the net difference. What is the net difference between it? Let's say you purchased the strike price was rupees 130. Like we are talking about the call option. The strike price, let's assume, was 130 and the spot rate is 150. That is favorable to you because the call option gives you a right to buy. So you can be buying at the strike price of rupees 130, whereas the market price is 150. So what is the notional value? Like the notional principal value was rupees 130 here, right? And further, you'll be getting the benefit over here and for the net difference is 20. The net difference is 20. That's a benefit that will be arising. So there will be cash settlement of this 20 rupees only, right? So that's about the cash settlement. So in case of the options, the cash settlement is being done. There is no full exchange of the underlying particular asset. Generally, that's not the case. And mostly what is done, mostly the cash settlement is only done. So I'm writing over here the net settlement, or let's say the cash settlement, right? That is being done. And if we're talking about the leverage, definitely the leverage is given to you. There is high leverage in case of the options. Why? Because the premium that you have to pay is much smaller than the underlying value. That, let's say that the value of the asset is rupees 100, but you have to just pay, let's say, 5% of the premium. Rupees 5 per share, you have to pay the premium. That's it. So it gives you leverage, right? And it leads to high leverage. So the small investments are going to control the large exposures, and there is higher potential for the return, but also definitely the higher risk is there. And primarily the options are used for the primary use I'm talking about, right? The primary usage. These are used for the hedging purposes, primarily used for the hedging purposes, but these can also be used for the speculation purposes. Like you must have heard about the option future and options trading, right? So that's basically a use for that particular case also. And there is term which is used, that is a plain vanilla option. Plain vanilla option means a standard simple option. There is no complex condition into it. And India, like, this is allowed. The plain vanilla options are allowed, and these are very much easier to understand. The pricing methodology is very easier, right? And these are mostly used for the hedging purposes. These are ideally used for the hedging purposes. Clear with it? So that was all about today chapter. Uh, and further, we'll be covering the next part in the next video. So if you want to get the CIB crash course, simply just do write CAIB crash and WhatsApp it to the number 83609 44207, and I'll be sharing all the details with you. Right. So thank you so much, and see you again in the next video.